It's that time of year where we talk about year-end tax tips, and things are a little bit different in 2020, of course, because of COVID-19. So let me begin with the first tip that we'll suggest to everyone this year is pay attention to your taxes payable. And I say this in particular if you've been receiving the CIRB, the Emergency Response Benefit, because that amount, which was $2,000 per period for up to 7 periods, that's $14,000. That amount was not subject to any tax deductions at source. That means that the amount of tax that you owe on that CIRB will depend on your 2020 income. So it's probably a good idea between now and the end of the year to really do an estimate of what your 2020 income was. Did you receive income, let's say, prior to March when you perhaps lost employment and went on to the CIRB? Or did you regain employment over the summer? And estimate what your total income is for 2020. For some people, there may be no tax at all owing on the CIRB because the tax rate is very low. And in fact, maybe the basic personal amount covers all of the taxes. For others who may have received a bonus in January and then were let go as a result of COVID-19, tax on that CIRB could be as high as 54%, depending on what province you would live in and how much income you have for the year. So good idea to take a look at your 2020 income, estimate that money, and then we set that aside so it doesn't come as a surprise next April when you have to pay the taxes on the CIRB. The other government benefits that were recently announced over the summer are subject to a 10% withholding tax. Again, that may not be sufficient. So again, take a look at your income for 2020. There are a variety of online tax calculators where you can sort of judge the amount of tax you're expected to pay. And if there's a shortfall based on the withholding on the new government benefits, then you may want to set aside that money as well. The second area that we talk about every year, of course, is tax loss selling. Depending on what you were invested in 2020, you may have lost money in a non-registered account. Whether it makes sense to then crystallize those losses will depend on the investment decision. Does it make sense to continue to hold that name in your portfolio? If not, maybe it's sense to rebalance that portfolio. Capital losses can be used against any other capital gains this year, carried back 3 calendar years to get a refund, carried forward indefinitely. One of the things you want to pay attention to when looking at your losses is the superficial loss rule. If you buy that stock or security back within 30 days, or your spouse buys it back, your partner buys it back, corporation buys it back, even a trust that you're affiliated with, like an RSP or TFSA buys it back, the loss is denied. So it's best to, if you're going to recognize that capital loss, realize the loss, and then wait at least 30 days before buying back that identical security. In terms of other stuff that we talk about near year end, RSPs, of course, you have the RSP deadline 60 days after the end of the year. TFSAs, there are no deadlines. There are certain restrictions on RESP contributions depending on the age of the child. Our year-end report covers all of these different planning opportunities, and we encourage you to take a look at it. One final thought to leave you with. If you do have expenses that you want to claim in your 2020 tax return, some of them do need to be paid by the end of the year. And I'm thinking things like interest. If you have deductible interest expense because you borrowed money for the purpose of investing, you must pay the interest by December 31st to get a tax deduction for the 2020 year. Similarly, with charitable giving, many people make most of their charitable giving towards the end of the year in October, November, and December. If you want that charitable donation receipt, make sure that the gift is made by December 31st. And a final reminder that if you do have some appreciated securities that have gone up in value over the last number of years, consider making a donation in kind. If you do it by the end of the year, you get a tax receipt for the fair market value. And if you donate securities, mutual funds, segregated funds in kind to charity, not only do you get that receipt, but you pay 0 capital gains tax on any accumulated appreciation. All of these tips and more are contained in our brand new updated 2020 year-end tax tips COVID-19 edition.